Strong dollar. So analysts generally expect the dollar to continue its strength into the end of 2022. And the drivers of the dollar strength have been higher interest rates in the United States, fueled by inflation, stronger economic growth expectations versus Europe and Asia, and the flight to quality, which is we call a safe haven. Now that'll affect cheaper imports and foreign travel, and the slowing of exports and corporate profits. So what we're looking at here is an actual chart of the U.S. currency basket versus other currencies. And you can see, going back to 2002, the dollar has been weakening. And then right around the 2012, when we had the taper tantrum, where Ben Bernanke actually was the first to start raising interest rates, the dollar has been steadily growing against most other currencies. And more recently, as the Federal Reserve has had an aggressive policy of raising interest rates to combat inflation, the dollar has really taken off, and now we're all the way back to where we were in 2002. Also looking at currencies, you can see the Mexican peso versus the Canadian dollar, the Chinese yuan, and also just looking at Japan, the worst performing index compared to the dollar has been Japan, Britain, and Europe. And that is going to have an impact on certain companies that do most of their business in Europe and Japan, and also benefit those countries that are exporting out of Europe. The normalization of the actual business valuations. So price to earnings ratio is a widely used ratio to value a company. The 2022 market sell-off has brought PE ratios back down to historical levels. Small and mid-cap U.S. companies now trade under their historical price to earning ratios. As you can see from this chart, looking at historical PE ratios versus where we are today, small cap growth is 64%, which represents about a 36% discount to its historical valuation. And mid-caps also are at about 70 to 71%, which represents about a 30% discount. We're not seeing much of a discount in the large cap area, but again, I think that's just because a lot of investors are hiding into those large caps because they represent some safety in this current market volatility. The business cycle update. So the outlook for the world's major economies has become more complicated and differentiated. Most countries, including the US, are in a maturing mid-cycle phase. Quality and minimum volatility stocks tend to outperform in a maturing cycle. And as you can see from this chart, looking at recovery, which is the early part of the cycle, this mid part of the cycle, and then the late or actual recession, most of the world countries, including Europe, Australia, Japan, the United States, Canada, are all in this kind of mid to late transition, whereas China is actually coming out of their contraction or recession cycle. So as you look at the business cycle and you then look at factor investing, different types of stocks outperform during different types of cycles. So in the early recovery, value in size tends to outperform. In that expansionary phase, momentum stocks typically outperform. And as you move into the slowdown, quality stocks and those minimum volatility like healthcare and utilities tend to outperform. And as you go into contraction again, they outperform also. So as we look into this late stage of the US cycle, we're tending to overweight those minimum volatility and quality companies.